Recording in progress.
Okay, in this tutorial, I'm going to be going over the four patterns that I typically look for when doing the slingshot strategy. These four patterns are most likely the reason why a lot of new traders get stopped out after placing a trade and most likely, going into profit. It is also the reason why a lot of people experience significant amount of drawdown before price actually goes in the direction of their bias, right? So what I explained to you here should be kind of an eye opener to why these certain situations happens while you're in the trade. All right. So what a lot of people don't realize about the market is that the market is made up of the bank continuously taking liquidity and creating liquidity. And if you don't understand how to identify that, it's going to cause you to enter the market in the wrong phase, which produces this drawdown and also produces situations where you tend to get stopped up because you're trying to protect your money based on where your entry points are. All right. Now, what a lot of people don't realize is if you are, a retail trader, and we're basically all retail traders, but if you're using retail concepts, then, we are taught to trade off of support and resistance. And honestly, that is not wrong, but it's which ones you trade off of that are important. Now, if you're someone who tends to want to trade the lower time frames, 15-minute, 5-minute, 1 minute, well, what happens is when you trade those time frames, you know that it's usually quick money, right? And what happens is if you're analyzing those time frames, you might be trading, inside consolidation, or you may be trading in an area where the market is not typically ready to reverse. It's just pulling back. All right. So what most traders do if you're trading and analyzing lower time frames, 15-minute, 5-minute, 1 minute, is if you do identify an area of resistance and you take a trade off that resistance, what you're going to do is most likely protect your trade by putting your stop loss above the previous high. And when you do that, the banks know your stop loss is there. That is why when you enter a sell and you go into profit, if it's currency, 10, 15 pips, you're blue, you're happy. Um, you get stopped out by this huge candle out of nowhere. And a lot of the times what happens is when you place your stop loss here and you take that sell, most likely your take profit one could be this blue line, or maybe your take profit two and you're ready to hold. You're feeling nostalgic because you're blue and you're expecting the market to continue to make lower lows and lower highs to your take profit. You come back to your chart and bam, stopped out. Maybe you went to bed and woke up and thought you were going to be in profit and you got stopped out. Well, the reason why you got stopped out is because you're trading off of a minor area of resistance and not this major one that most likely you would have identified on a higher time frame, like a 1 minute, 4 hour, or even a daily. All right. So that's the one reason. The other reason is the person who trades this breakout. All right. Now, the people who trade this breakout usually experience some form of drawdown before price continues, or have no idea that the market is ready to reverse. Now, remember what I said, the bank likes to take liquidity and then create liquidity. So for the people who trade the breakout, what happens is they're most likely waiting for price to break out of some kind of consolidated phase. But a lot of the times, it's not going to look as perfect as this diagram. The market will sneak out. When the market sneaks out, what happens is it'll come back in and either stop you out, or it's basically called a fake out. Now, if you get faked out 2 or 3 times within this range, thinking that the market is ready to break out, by the time the market really breaks out, you're already tainted and you're scared to enter. You might have been waiting for a few hours for this breakout. You're ready to give up, and then bam, here's this candle. Well, if you don't get the entry right here, what you're going to do is eyeball this breakout, and you're going to try to make sure it's going to stay out. Little do you know that it's creating a phase in the market that you should not enter on in the first place. Now, if the market is at a reversal point, it's even worse, because this is what happens. What you're going to do is you're going to watch this candle play out, and it's going to kind of keep pushing, keep pushing, keep pushing, and then all of a sudden FOMO is going to set in, and you get this fear of missing out. So what do? You enter in the middle of this candle. Now, the good thing is you will go into profit, so you're happy. Your phone is blue. You got maybe 10 or 15 pips, and you're Gucci. So you think, because what happens is the area of resistance that you didn't identify on that higher time frame in your analysis, now the market is right there, and now you're in this drawdown. You were 10 pips in profit, now you're 40 pips in drawdown, and you're worried if the market is going to come back and at least either take you to break even or put you back in profit. Now, the banks know you do this, and they also know that the market usually could do this thing called a breakdown retest. So you may be, reanalyzing the market. You may say, okay, you know what? I did learn this. This is just that retest. That drawdown is just a phase, and we should get this continuation to the upside. Now, in certain situations, you could be right, but we're at a reversal point. This is a reversal pattern. So what's going to happen is this pullback is going to pull back into an area of support, and then it's going to start going up. Now, as it starts going up in your brain, you're like, see, I told you that was just a retest. I'm most likely going to be, in profit. I'm at break even because of this candle. And then the banks will push price down again and scare you again. Then all of a sudden you think, okay, I heard about this. This is that double bottom, right? That I keep hearing about. I'm going to hold, right? Haven't hit my stop loss yet. We're going to hold. Market starts coming back, so you're hopeful again. Now you're at break even, but you actually got a little bit of profit. So you're like, you know what? Let's get this continuation. And then what happens? The bank fails to break the previous high. They enter here, and then all that hope that was created on this candle, the banks take it. And the reason why that is because this is the phase where the bank is creating liquidity to reverse price. All right. Now, the only way to identify this is by identifying the strongest levels of resistance where the market reversed in the past, right? On higher time frames, right? So what you're going to have to do is you're going to have to start on the higher and work your way down to the lower to identify this, all right? Now, the banks take liquidity from sellers, run price into an area of resistance. They will push the market into what I call a push phase, right? And that's this phase right here where you see this purple line. This push phase, if it already starts to happen, you do not enter. The reason why is this is the phase that will produce drawdown if you enter. If you enter here, right, thinking the market is going to drop to this take profit, well, what's going to happen is it's going to start pulling back, right? And when it starts to pull back, this will scare you and think the market is going to continue. So what we got to realize is that in order for the bank to reverse price in this area, the bank is going to collect orders. And what they're going to do is they're going to trick retail traders into buying off of this support, right? So these green lines, they represent retail traders who are buying, right? Those retail traders, what they'll do is they'll put their stop loss below these lows, protecting their move to the upside, right? Now, once this happens, the bank will do what? The bank will push price up, make these buyers think the market is going to continue because of the traders who think that this is a break and retest, fail to break this high, and then the banks will enter in this region and then take the ride down past these lows to collect the order. Once they collect this order, they are funded to go to take profit one. Now, my take profit one would be this line right here, this area of support, right? And the reason why is because these people bought off of this support and they did the same thing as these sellers. They put their stop losses below this low, right? So the bank is going to collect the order and now they're funded to go to take profit one. And as you can see, once this passes take profit one, the bank took the liquidity or stopped these people out, right? And now they're funded to go to take profit two by doing what? By doing the same thing. They will trick buyers again. Those buyers will put a stop loss below these lows to protect their buy, and then the banks will fail to break the previous high again, and they will get into the trade up here and trade toward this order. Once they collect the order, the bank is funded to go to take profit two. All right. And now that's what you have to realize about the market and be able to identify. Now, the reason why drawdown is minimal when you enter trades this way toward liquidity is because you're trading with the banks now. If the bank enters up here, you're going straight into profit, right? If you enter a sale here, you're going into drawdown before you go into profit. So what we're going to focus on is entering the market in the appropriate phase and always be trading toward liquidity. All right. And that's what you have to focus on your entries. When you enter a trade, ask yourself, are you trading toward liquidity? Because if you are, you'll minimize drawdown. All right. Now, this is the pattern for a reversal to the downside for a sell. All right. Now, the pattern that we use for reversal to the upside will look like this. All right. And it's the same thing. We have people who buy off of a minor area of support. They will put their stop losses below these lows. The bank will stop out these buyers by running price into a stronger area of support on that higher time frame, 1 hour, 4 hour, or even the daily. And then the same process happens. Before price can reverse, the bank will create orders. Now, these orders are the bank creating liquidity. So what happens here is the bank will push the market into a push phase. That is this green line here. And then instead of tricking buyers because we're going to the upside, we're now going to trick sellers. Now, to trick sellers, what the bank does is they create a minor area of resistance, and then a seller will sell off of them. But the bank will make sure that they fail to break the low. These sellers will sell, tricking the people into selling and failing to break this low, right? And as you can see, if the bank fails to break this low, then what they're doing is they're just setting up to take out the orders from the sellers that they tricked to push price up. All right. So once the bank creates liquidity by tricking sellers off of a minor area of resistance, and they have protected their money by putting a stop loss here, because the bank fails to break the low, the bank is going to enter right in this region where this blue line is, right? And then go up. Once they go up, they collect the orders from the sellers, and then bam, we're off to the races to go to where? Take profit one. This is take profit one. Why? Because these people sold off of this area of resistance and protected their money by putting stop losses above this high, right? Now, once the bank goes above this high, we have taken liquidity. So like I said in the beginning, when the bank takes liquidity, in order to go higher, what do they have to do? Create liquidity. So what will happen is this stop loss, right, will be put here by the sellers, right? The banks will enter the trade in this region, and then the bank will go to take profit too. All right. And that's what you have to be able to identify. What phase is the market in before you enter the trade? If you enter a buy up here, right, then you're entering in the wrong phase. This is what I call a push phase. The bank has to create liquidity. Once liquidity is created and you have a stop loss to trade to, you enter below and trade toward it. All right. Very, very simple. So these are your two reversal patterns. All right. Reversal patterns. All right. Now, the other two patterns are what I call trend continuation patterns. And it's basically the pattern that forms after price reverses. Once we get below this structure, this is the pattern you're going to be looking to trade if you come to the chart after the reversal point, right? Same thing. This will be the pattern you'll be looking to trade once price gets above this area of resistance. Now, this is the trend continuation trade for price that's trending up. This is the trend continuation pattern that you'd be looking for when price is trending down. And it's the same thing. We have sellers who sold off of a minor area of resistance. In this situation, we are in an uptrend. The bank stops out these sellers, right? They stop out the sellers. And then price will run into what I call a minor area of resistance, because this is an area where we know the bank is not reversing from. And then the next phase will be for the bank to do what? Create liquidity, right? So they're going to trick sellers, right? They're going to trick sellers into selling. And then above this high will be a stop loss, right? There will be a stop loss right in that area, right? So if there's a stop loss in that area, and we know this is a trend continuation, then this is that break and retest situation that will make sense. the market will come back to an area of support. And then what will happen is, and the bank likes to do this, they will actually create liquidity within this small little range. They'll trick sellers into selling one more time. There'll be an order up here, and then the banks will enter in this region right here. They'll take out this order, they'll come up and take out that order, and then it's off to the races. After that point, the bank will do the same thing. After they take liquidity, they'll create liquidity back into support, and they'll continue to keep going. All right. And that's what you have to understand about the market. It's all set up to confuse you. All right. The bank is going to take liquidity and then create liquidity. All right. Now look at this diagram to the downside. Right. Now this is what we'd be looking for if price was below this area of support. All right. Same thing. We have buyers that bought off of a minor area of support, right? We're trending to the downside. These buyers protect their money by putting a stop loss below this low. We have a break of structure into a minor area of support, and then immediately the bank is going to do what? After they take the liquidity, now they're going to create liquidity by doing what? Now, in this pattern, what we're going to do is we're going to trick buyers into buying. So as you can see, we have the green candle. The market buys. The moment the market buys, below this wick is liquidity, right? There's your liquidity right here. That's the start of it. That's your first order. Now, if you notice, when the market starts to reverse to the downside, they manipulate a lot more before price goes down versus when market goes to the upside. So you might get a little bit of sideways movement, consolidation. You may get structures where highs get broken on the top as well. So you have liquidity on both sides. You'll have buyers that got stopped out. You'll have sellers that got stopped out, right, by this move. But below here, there's tons of orders and tons of reasons for the market to drop, because now we have all these peaks. We have one here, and one here. So we have three orders, which are three reasons for the market to drop. The banks are going to enter up here, and what do? As soon as they break this low, right, below these peaks, they're funded to keep going. The moment they break below this one, they're funded even more to keep going, and then you'll get that move and continuation. And then it's the same thing. The market will break structures, they'll pull back again, and then the bank will keep going. All right. Now, if you understand this about the market, it will make your analysis, it'll make your entries that much better, and produce less drawdown. Because if you enter where you're trading toward these areas of liquidity, you'll minimize drawdown, right? And that's the goal, is to minimize drawdown, especially if you're someone who wants to trade an indice. All right. Now you're going to notice on your chart that I have these RTDs and RTPs. The reason why I have that in these areas where the liquidity is because it's me identifying that I've spotted liquidity before my entry. So RTD means reason to drop. So when I draw that in my diagrams, which you've probably seen in my videos, that's me identifying that I've spotted liquidity and the bank giving me a reason for the market to go to the downside. All right. RTP means reason for the market to push, which means once I've identified that orders have been created and liquidity has been created, I need to know that if I enter the trade, I need to enter below these peaks so I don't go into drawdown. Because if I enter above these peaks before the bank is finished creating liquidity, then I'll get caught where the banks are tricking sellers and go into drawdown. And that's what we want to minimize. We want to make sure that we enter at the beginning of the market where they start to take out the liquidity. All right. And it almost seems like you're entering the market backwards, but you're not. You're waiting for the bank to create the orders. So when the bank is ready to take the orders, you're in the trade with the bank. All right. Very, very simple. All right. Now, if you look to the left, I have this small little diagram of price in a downtrend, making lower lows, lower highs, lower lows, lower highs, lower lows. Each one of these peaks that I have highlighted is where there's liquidity, right? And what you're going to notice is that when the bank pulls back, these are buyers. Those buyers will put a stop loss below here. The bank will enter here and take out the liquidity. Once liquidity has been taken from buyers, in order for the bank to go lower than this point, the bank has to trick buyers again. So you'll have this zigzag move up, and then the bank created 2 orders this time. So there's liquidity here, liquidity here. The bank will enter up here and take out both orders to fund the move to the downside. And then for the bank to go lower than this point, guess what has to happen? The bank has to trick buyers again. There'll be liquidity below this point. The bank will enter here and take it out. All right. Now, in an uptrend, it's the same thing. You have the market making higher highs, higher lows, right? Higher high, higher low, then a higher high. Above where this is highlighted, at each one of these peaks is a stop loss from the sellers this time that sold and protected their money, trading in the wrong direction. These are people who are trying to trade against the trend, right? So where are the banks going to enter? They're going to enter here to take out the stop loss, right? For the bank to go higher than this point, what are they going to do? Trick sellers again, create liquidity, and then the bank will enter down here to take out both orders. They'll take out this order and that order and fund the move. And then it's the same thing. In order to go higher than this point, because we just took out liquidity, we'll trick sellers again. Those sellers will put a stop loss above these highs, and then the bank will do what? Push to the upside, right? Now I'm going to show you an example of this on the live chart. All right, so let's go to US 30 and let's see if we can spot a situation where that's happening. All right, so right here is a good example of trend continuation. All right, and I'm going to show it to you. This is actually on the 1 minute time frame, but I guess I could show this to you. All right, so check this out. All right, if you notice, we have a high, right? We have a high. Try to make this as perfect as I can. And we have a low, right? We have a low, right? And we're in an uptrend, right? We're in an uptrend, right? So we know that we're bullish. Now, notice we have sellers, we have buyers, right? And this is really exact, all right? Now, if we have sellers and buyers, right, then there's liquidity above these highs. There's liquidity above this wick. We know there's liquidity below these wicks, but we are in an uptrend. Now, if you look real close, and it's crazy because I can't believe that they took liquidity like this, but they did. If you look at this wick, this price action goes above this wick. That means there was liquidity grab. Liquidity got taken from these wicks. And if you look at it, this wick took out all the liquidity from these sellers, right? So we had liquidity taken from these sellers, and then above this high, liquidity was taken from these sellers, and now we're in an uptrend. If you look at this, this is your break of structure right here, and it happens on every time frame, right? And then above this high is your RTP, reason to push, RTP, right? Now, after this, what is next? The bank has to trick sellers, right? After the break of structure, the bank will trick sellers, right? So in order to go higher than this point, right, the bank will do what? Create liquidity. Your entry will be down here in this area, and then you'll be trading with the banks for this trend continuation. As you can see, the market continues up, taking out this order, right? So this particular pattern is this pattern right here, right? Maybe not as pronounced, but we did hit a break of structure. The bank created liquidity. We had an RTP. We traded toward it. All right, so you look at the diagram. We have a high, a low, a break of structure. The banks trick sellers. Above this high is liquidity. Your entries here, and then off to the races. All right, trend continuation. All right, so let's look at, see if we can find one where the market's reversing. We'll actually go to a higher time frame. Right. Let's see if we can find one of those. Show you a good example of that. All right, so let's look at perfect right here. All right, so notice this is a 5 minute time frame. The market is in a downtrend. We had low, high, low, high, low, right? And then at this point, most likely we're at a strong area of support. We can double check that by drawing a line here and then going to a higher time frame and just seeing how strong is that level. All right. So look, we have break retest. So we know this is being treated as resistance. We broke resistance and we're back treating this line as support. Good enough for me. All right. We'll go back to the 5-minute time frame. Right. Right. And now look at the pattern that we have here. Right. Look at this. Right. Right. So you have a high, a low, right? I'm gonna draw it like that. We do have one in here as well. One in here as well, right? So we have buyers, sellers. Excuse me, I said that wrong. We have sellers and buyers, right? That got stopped out. Then we had another break of structure here, right? So we stopped out these buyers. So we already know that above these highs is liquidity, right? Now we do see previous structure high up here. So we can draw a line here, right? Now look at this pattern. We have a high, we have a low, right? And a break of structure. So look at this pattern here. We have a high and a low and a break of structure into a strong area of support, which we identified on the 4-hour time frame, right? Let me get rid of this now, right? And then look what we have over here. Now, in order for the market to go up, the bank will create an order. Now, this area right here is the push phase. So look at this. See this push phase, right? We break above this high. So that's this part of the pattern, the green candle, the push phase. The next phase will be for the bank to do what? Trick sellers to create liquidity above this high. So look at the diagram. All right. We have a push phase, right? And then the next phase is to do what? Trick sellers. Notice the purple candles. We trick sellers back into this support line. Now, above this high is where I would write RTP because I've seen an order being created, right? So my entry is going to be before price breaks above this high. The banks are going to enter right here in this area somewhere, right at these wicks. Now notice if you enter here, right, put your stop loss below this point or aggressively, conservatively below the previous low, then you're off to the races, right? Because at this point, we're going to collect all these orders here the moment price gets above that high, and then look where the market goes. Go straight up for 4,900 points, right? Now, we already know that this is our previous structure on this 5-minute time frame. So if you wanted to target this high, well, you just have to endure one more pullback. The reason why the market is pulling back is because, just like I said in the diagram, in order for the market to go higher than this point, we have to trick sellers again, right? Look at the diagram. We trick sellers again. Your new RTP will be above this wick, and the banks will trade toward this. And as you can see, we go right to it. 3,500 points from that entry. All right. That's what you have to understand about the market. When the bank takes liquidity, all right, this push to the upside takes liquidity from these sellers. The next phase for the bank to create liquidity by tricking sellers, all right? When the bank takes liquidity from all these sellers, the next phase for the bank to do what? Create liquidity by tricking sellers, right? Giving you an opportunity to trade towards your RTP. And as you can see, the bank will double dip. They'll push price up again, tricking sellers to buy off of this, thinking this is the retest. They'll trick these buyers. Those buyers will put a stop loss above these highs. So there's actually an RTP here, right? They'll trick sellers again. And then the bank will take out both orders, this order and that order. And as you can see, that's exactly what they do. And then look at this. This is how precise it is. You see how this high breaks above this high. right? That means liquidity has been taken. In order for the bank to go higher than this, the bank will trick sellers again, creating an RTP above this high, and then the banks will enter down here and then continue. And that's really, really all you need to understand about the market. When the bank takes liquidity, they create liquidity. All right. So hopefully you guys got a good idea of what you're going to be looking for. These are the 4 patterns that I teach. So hopefully, this is an eye opener for you guys. All right. That's going to conclude this video. Have a good one.